While the global investment environment is still very much focused on the US debt ceiling and on China driving growth, equities are still cited as the preferred asset class for investors, with returns expected to be in the early to mid-teens. Suraj Sookdhew, who's portfolio manager at RMB Private Bank, joins us now to chat about his approach when it comes to investment strategy in 2013. Thanks so much for joining us this afternoon, Suraj. Let's get straight into things on a global scale first. Looking at the US, we have the risk event focus for the month of December. The US fiscal cliff temporarily resolved in the last minute, temporarily being the imperative word right now. Have we just added another dent to what's already a pretty battered can?
Yeah, look, I think most people or most commentators will tell you that some kind of resolution will be found. Whether they're just kicking the can down the road, is another story. But we think, given the implications if they don't lift the debt ceiling, it's so massive that the fiscal cliff is small compared to the debt ceiling. So we think that they will find a resolution. It'll go down to the 11th hour, but something will come through.
Suraj, of course, we knew what would happen with the so-called fiscal cliff. We know what's going to happen with the debt ceiling, just like it happened back in August. We went right to the 11th hour, if you like, and everything was resolved, and we bought ourselves another 6 to 7 months, whatever the period is. It's going to happen again, so we don't need to worry about that. Everything seems rosy at the moment for equities. In terms of asset allocation, is equities your preferred asset class?
Yeah. Look, I think given the low interest environment that we are, in South Africa and internationally, you have to go for equities. You're getting decent returns out of them. I mean, if you look at last year, the environment that we were in was, sovereign debt crisis, and yet the returns that you got from equities, I think, surprised most people. I think going into this year, we think that we won't see the same returns out of equities, but still looking for 12-13% out of equities, which will beat your bonds and your cash. So I think, low interest rate environment, risk on trade back on, we'll see, a flow of funds to emerging markets, and South Africa will benefit from that.
It's interesting that you say you're not expecting the same kind of returns, because the returns we got last year in a very dismal environment, economic climate, moving into 2013, we are venturing in with a pretty positive outlook for the 2013 period. Just how hard has it been managing expectations?
Yeah, look, I think if you look at our client base, it's conservative investors that have been in the markets for a long time, and they understand, as we go along, markets will be volatile. And, you just got to speak to your clients. You've got to buy assets that, with strong balance sheet, good dividend flows, and, those are the best type of assets to have.
Suraj, when you speak to your clients, is there a note of warning there as well? I think that we've got the S&P 500, which is probably the most representative index of the United States equity market, at a 5-year high at the moment. I think something like 93% of S&P 500 companies have recently hit a 52-week trading high. So as I said before, everything seems to be rosy. And we've also had this amazing figure, which was reported in a lot of the press over the weekend, that net inflows into equity funds has hit $22.2 billion in the week to January the 9th, the highest level since September of 2007, and the second highest since data began in 1996. The reason I bring this up, Suraj, is because when I used to speak to Di Turpin, who used to head up the Unit Trust Association of South Africa, she used to say to me that in South Africa, certainly, the retail investor got it wrong. When the market was about to go up, they withdrew their funds. When the market was about to go down, they did the opposite. I wonder if this data that we're seeing is a warning signal to equity investors.
No, absolutely. Look, strong flows, off that number, I think it was 7 odd billion that went into emerging market funds, equity funds. So we think on the back of that, because your alternative is giving you so little, that funds will come into emerging markets as they seek yield. I agree that beginning of last year was a time when you needed to buy equities and to top up as much as you could. But I think people were concerned, and I think going into 2013, we tell our investors that markets are going to remain volatile. But if you look at the alternatives, you're getting so little from cash, you're getting so little from bonds that if you buy companies with decent yield, dividend yields, that you'll be okay.
So where exactly are you topping up when it comes to that equity space? Where are you seeing a scaling up and where are you seeing a lessening of your load?
So if we look at the global environment, we're saying that we're seeing some good data coming out of China. The USA will probably give you about 1.8% on the GDP number this year, which is fairly decent. And then we'll look for a little bit of growth coming out of the Eurozone in the latter half of this year. So on the back of that, we think that the resource counters have been sold down quite aggressively. And given the returns that we had last year, we look for a little bit of a rebound in some of those resource counters. We have seen some of that already. But if you look at Anglo-American at the valuation levels that they are trading on, it is looking attractive. And I think the market likes the fact that Mark Cutifani is coming in. He's well rated, and we think we'll see some good numbers coming out of Anglo-American.
Now, Suraj, I think three of the themes you must look at in 2013 from a layman's point of view. You've mentioned one, and that's resources versus the very highly priced local stocks, industrial stocks in particular. Within that, the retail stocks. We'll get an idea of the retail stocks' performance over Christmas, and maybe that will shape their whole year in the next few days. We've also got developed market economies and markets versus emerging market economies and markets. Will there be some increased dislocation there? And the other one, which is a really big one, is the bond market. The bond market has started to show signs of fragility. Can the bond market unravel? And if it does, where does that money go? Does it sit on the sidelines, or do equities get boosted by it? Should that money start to flow out of the bond market?
I think locally we are seeing some weakness in the bond market. I think inflation is becoming a little bit of a concern. We think that inflation will be slightly above the 6% level. So in that space, we prefer inflation-linked bonds versus your traditional vanilla bonds. But if we see a sell-off in the bond market, we think the natural home will be the equity market. And on the back of that, that's why we prefer equities. I think internationally as well, if you look at the US 10-year government bonds trading close to the 2% level, a lot has been said about a bubble being created in the US bond market. And should we see further weakness in that bond market, then the natural place will be the equity market for those funds.
Well, what are you making of the kind of uptake we're seeing over in Europe? I mean, last week we had strong Italian debt auction come to the fore, and that's surprising many.
Yeah. I think with the Eurozone, I think it's going to muddle along. We've seen for example, the Greek yields strengthen quite aggressively into last year, into the close of last year. So I think people are getting a sense of comfort in that market, and on the back of that, kicking the can down the road, Eurozone to muddle along, equities is still the preferred asset class.
Very quickly, Suraj, as we end this, the South African Rand has started off the new year in not dramatic fashion, but it's maybe showing its hand for what might be happening for the rest of the year. It wasn't so long ago that the euro-dollar exchange rate was 130 and the dollar-rand was 850. Now we've got the euro-dollar essentially 134 and the dollar-rand 870. So we've had a 20-cent move when actually the 20 cents should have been in the other direction. The rand showing independent weakness. Will that be a theme for you to watch as a portfolio manager this year?
Yeah, definitely. We think the rand will stay at elevated levels, not to weaken too aggressively. If anything, if the risk on trades back on, then we can see the rand strengthen. But we've got some unique problems. We've got the current account deficit that's a bit of an issue for us. We hope that gets resolved towards the second half of this year. And then I think the labor issues in this country is becoming a bit of a concern. But like I say, if the risk on trade is back on, despite our own internal issues, and if funds flow into emerging markets, you can see the rand strengthen from these levels.